there's a lot of great books on financial planning. But the question is, how do you actually put into practice the things that they talk about in the book? And this is not a review of any one book. This is a review of my philosophy as a financial advisor over 20 years. This premise that when you've won, when you're in retirement, you should have what I call a without worries investment portfolio, so you can sleep at night and you don't have to worry about your investment portfolio. I was going to write a book called WOW, W-O-W, and talk about without worry. But I don't have to write that book because another gentleman, Bill Perkins, wrote a better version of that book than I could ever hope to write. And that book's called Die with Zero. So in today's video, I'm going to walk through how do you build a portfolio that's consistent with the main message of Bill's book, that's consistent with my theme of a retirement without worries. You don't want to be staying up at night worried about your investment portfolio, worried if you're going to have enough money to survive a decade from now, worried if you're going to run out of money. So how do you build an investment portfolio to do this? Okay, let's jump in. The first thing is it's important to have an emergency fund. Now, when you were working, an emergency fund was designed to give you time so that you could find another good job if you got laid off, got sick, for whatever reason, wasn't able to bring in your normal income, or you had a huge surprise, a medical bill, a big car expense, maybe a car accident. And so an emergency fund was designed for that. Now, when you're retired, you don't have to worry about what happens if you lose your job, but you still have to worry about what happens if you get a big medical expense, what happens if you get in a car accident and you have not only medical issues, but you've also got to replace your car. So there's still those same issues in place. And one of the secrets to succeeding in your investments is never being a forced seller in a down market. So if your car breaks down and it just happens that the market's down 20 or 30% and you don't have an emergency fund, where is that money going to come from? And you don't want to have to sell positions in your stock portfolio to get there. So rule number one is to have an emergency fund. Now, I personally, I have, people in my industry would say you should have 3 to 6 months of living expenses. That's a good rule of thumb. I think more gives you more peace of mind having a larger emergency fund. And full disclosure, mine is quite a bit bigger than what most people's is. I have a 2 years worth of an emergency fund, and probably some of that has to do with my childhood growing up and just my life experiences. And I like the idea that I can fund my living expenses for 2 years, and that's probably a mental shortcoming that I have, but it gives me peace at night factor. So that's the first one. The next item is make sure that you have your asset allocation right, what your mix of stocks and bonds are. Everybody thinks that they're looking for the next Warren Buffett when they're looking for an investment manager. But the reality is your asset allocation is going to determine 80 or 90% of your returns for the vast majority of us. Now, granted, if you had a chance to invest in Google when it was a startup, that would be an exception to that rule. But for most of us, it's our asset allocation that's going to impact and result in 80% of how we do either successfully or unsuccessfully. So get that asset allocation right. What's the right mix of stocks and bonds? And I want to caution you because as we get older, our risk tolerance changes. As a fee-only financial advisor for 20 years, it's been very common for me to have somebody come and visit with me that maybe has been running a company for 15, 20, 30 years. And they're very comfortable with risk, right? That's just the reality when you run your own company. You get the upside, but you also get the late at night worries about, what's going to, when COVID started, how's the company going to do, things like that. And people that run their own companies tend to be very comfortable with risk. And a lot of us, on the flip side of that, is if you've had a very steady paycheck, you never had to worry about being laid off, you know, you're probably more comfortable with risk than a lot of people. But once you retire, once that nest egg is everything, and it becomes much more difficult to replenish that nest egg, the way you look at risk changes. So I would encourage you to work with a fee-only financial advisor, really have a thoughtful, a deep conversation about what the right asset allocation is for you, and then revisit that every couple of years because life changes. So getting that asset allocation right is gonna really help with that sleep at night factor and make sure that you're not worried, are you gonna run out of money? Okay, the next thing is succeeding as a long-term investor, meeting your financial goals is a factor of several things. One, we've talked about the asset allocation, but another one is not blowing out of your stocks when they're scary, out of your equity allocation, right? So a lot of retired people are gonna have an asset allocation, you know, 30% stocks, maybe up to 70% stocks. And this is not a recommendation. I'm just sharing what a lot of retired people have. And let's say you're at 70% stock allocation and, you know, another great financial crisis happens, something like that. Do I think, and that one peak to trough was almost 60%. The S&P 500 was down almost 60% peak to trough. I think it was 57%. That'll take your breath away. And if you're in a 70-30 portfolio, you know, in theory, that portfolio is going to be down by a third. It's going to be down by 40%. So if you've got $1 million portfolio, you're down $300,000 to $400,000 even in a 70-30 portfolio. Now you probably have 5-6 years worth of spending in your bonds, but your bonds are the only thing that didn't go down. Actually, in the financial crisis, a lot of bonds did go down because people were worried, are these companies going to be able to pay back the debt? And bonds are basically debt. So getting that asset allocation right is so important. The other thing is, I personally, I'll share with you one of the things I share with my clients is it's nice to have some dry powder, so that these down days in the stock market can feel quite a bit different to you, right? The challenge when the stock market goes down, you're like, oh, you know, I can buy this company that I've always been a fan of, and it's trading 30-40% less than what it was 6 or 12 months ago. Well, the challenge is, what are you going to sell to raise the money to buy that stock? So if you have to sell something that's down 40% to buy something that's down 40%, that doesn't feel so good, does it? So having some dry powder, having some cash, maybe even 5 to 10% of your portfolio in cash. And now that money markets are paying a higher interest rate, you know, as I record this, you can fairly easily get 4% or more in a money market account. So the penalty to have cash is less. But the nice thing about having cash is if there is a market correction, that market correction, stocks being down, feels a lot different when you can pay cash for another stock that's down that you've always liked. So it's about being able to stay in the game. It's about being able to sleep well at night. It's about having a without worries portfolio, a wow portfolio, or as Bill Perkins would call it, a die with zero portfolio. On a similar note, I want you to watch this video here, which talks about 8 things to stop doing as you approach 60 to enjoy life more. I'll see you in there.